So the economy is already rapidly deteriorating. So if the Fed does nothing, the economy sinks. If they fight the inflation, the economy sinks. There's just no way out of it. And it's of course it was going to end up this way, because you can't live in the twilight zone forever. This is the revenge of the real economy.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He joins us this Monday, March 14th, 2022. Mike, thanks for coming back on.
Always a pleasure to be on with you, Dunnigan.
You always bring a fresh perspective when you come on, because as an active money manager, you're closely watching forward-looking indicators to try to keep people out of trouble and keep them in the right spots. And it's a challenge to do in a world as confusing as ours. That's what I'd like you to give you a moment to do, if you would, is just to give us your high-level view, because you've set us up for the past couple of quarters to talk about some major events you expect us to be passing through, and to give us an update on where we are in that process as things change constantly in the financial and geopolitical world. And just what are the main signposts that you're seeing us either passing now or that you see in the near future that you think people need to be aware of and watching out for?
Okay, so as you know, the IDEC model, the inflation-deflation economic cycle model that I created, was telling me to get more bearish right in January. So I actually put hedges in the portfolio, took positions in short market ETFs in January, in preparation for what I thought was going to be a really bad April, May, June, second quarter. But I also had the idea that maybe people were going to start to sell perhaps ahead of that. Now, Vladimir Putin did not call me and say he was going to invade Ukraine. But had he called me, then I would have, of course, been even more bearish than I am, and the portfolio would be doing even better. But he did not. But the predicate here was that the economic growth was going to slow very sharply, and we were going to start to see some disinflation. So on the second derivative basis, we would see inflation start to drop from 7%, 8% down to 5%. That didn't happen because, again, of the war in Ukraine. But that only makes me even more confident that growth is going to be much slower than Wall Street could even dream of in the second quarter, on a year-over-year basis, even on a month-over-month, quarter-over-quarter basis. So you're starting to see some of the high-frequency components of my model really start to flash red. Let's just talk about Chinese debt, for example. 25% junk bond yields in China. High-yield spreads to treasuries here in the United States, they're really starting to blow out. The yield curve spread, the 10s minus 2s, collapsed from 150 basis points last year. Now it's just 25 basis points. So you have a predicate based on the second derivative of inflation and growth, and that's primarily based on the monetary policies and the fiscal policies of the G3 nations. It's confirmed by the actual data, and that's how you invest. So rather than being down, isn't it better to be maybe up a little bit than being down in a Cathie Wood ARK investing portfolio that's getting wiped out, the NASDAQ that's entered into a bear market, the S&P that's down 11% this year is one of the worst years one of the worst starts of any year, 2022. And we haven't even hit the worst part of it, which is the second quarter. Now, I will say this. We have a Federal Reserve meeting on Wednesday. And this is where it really gets exciting for me, Donovan, as a money manager. And I've been doing it for 31 years. I'm not a greenhorn. When was the last time we we were entering into a recession and the Fed had its interest rates at zero? And the answer to that is never. Never. As a matter of fact, the Fed just ended QE a few days ago. They were still actually adding to the base money supply with 8% year over year, 7.9. We'll call it 8. It's actually closer to 15 if you did it, measured it correctly. But the Fed was actually increasing the supply of base money, Fed credit and physical currency, as of last week. Just ended. So you have inflation's killing the consumers, inflation's killing the economy, higher interest rates are killing the economy, the fiscal cliff is killing the economy. And guess what? We're having starting this Wednesday, the upcoming Wednesday, the monetary cliff is going to start. So I'm less interested in the amount of rate hikes. I think we're going to get at least ostensibly 5 rate hikes penciled in for 2022. I don't think they get to 3. I think by the 3rd rate hike, so you're talking about June, July timeframe, I think everything falls apart, including the high yield market completely melting down. And the Fed has to do a mea culpa and say, once again, I can't get anything right. And they have to reverse course. But the most important thing I'm listening for Wednesday is not how many, I know they're going to do 25 basis points. I'm not worried about this. I want to hear the schedule for quantitative tightening. That's the most important thing.
Yeah, that's the question that one of our viewers, Bruce Barr, asks. He says, this week with the Fed to raise interest rates, but they're still adding to their balance sheet. This strategy will not do anything to bring inflation under control. Do you think the Fed is serious about controlling inflation? If they're serious, they need to aggressively raise rates and simultaneously quantitatively tighten. But the federal government needs to get in spending under control or go bust. They're not going to do this. So I ask, how serious is the Fed on controlling inflation?
Did you listen to what used to be the Humphrey Hawkins testimony, Dunnigan? Did you actually hear Jay Powell talk about quantitative tightening?
Yep.
Well, he was asked from the senator from Georgia, I think it was Ossoff, asked him this question. How deflationary is quantitative tightening? And in regards to the housing market, how are you going to be able to stop home prices from going up because you're priced out of first-time home buyer? And Powell actually said this. He said, well, it's going to be very inconsequential, paint dry, grass grow. You get the point. Because when the Fed gets money for a treasury that's maturing, it just hands the money back to the treasury. Then again, that's not true. I don't know why he said that. He said it very clearly. I rewound the tape several times to make sure. Did I hear that right? So when the Federal Reserve has a treasury maturing, a treasury bond maturing, they need to get paid the principal. Okay? The treasury has no money, so they sell a bond to the public. The public then gives the money to the treasury gives the money to the Fed, and that money is destroyed. It's not handed back to the treasury. You are attenuating, you're reducing the amount of Fed credit in the system. That's the process of quantitative tightening. So the viewer asked the question. They have no choice but to do it. I know if you're a gold bug like me, you would like to say that they can't do it, but they have no choice. You have to live in reality. This is what's happening. The Fed could maybe say, I don't really want to fight inflation because I'm worried about Ukraine and Russia. I'm worried about the economy. They could say that if the Fed's balance sheet wasn't $9 trillion, if inflation was 4%, not 8%, if the Fed funds rate was 2.5%, not 0. So it's an untenable, it's not a position that they can maintain, that they're not going to fight inflation at 8% because it's that very inflation that's destroying the people they care most about. They will attempt, at least feign an interest, to raise interest rates, destroy the money supply by quantitative tightening until something breaks completely. And I think they'll break it by the middle of this year.
Well, that's another question from another viewer. Sergei Levakin asks, What would happen if inflation is still 8 to 10% by the end of 2022, but Fed funds rate is still 1 to 1.5%?
Well, this is the question that you're asking me. I would like to ask Powell that. See, no one ever asks him the right question. They ask silly questions, like how can we increase lending to a certain, demographic? What the Federal Reserve should be worried about is maintaining the purchasing power of the US dollar for all Americans. That should be their only priority. So if I could ask a legitimate question from the Federal Reserve, I would say, listen, in stagflation, this is basically the crux of the question, which do you care more about? If the economy is melting down, but inflation is still high, what do you do? Well, the answer is no matter what they do, they're damned, because if they do nothing, inflation will get, waxed higher. And if they attack inflation, well, maybe they could, I'm sure they have the tools to do it, but they'll kill the economy even faster than it already is crumbling. So, it all depends on, I guess if I could answer for Jerome Powell, it all depends on how fast inflation is going to fall in that second derivative context. So, but given the war in Ukraine and in Russia, it's not going to fall as fast as even I initially thought it was going to fall. So he's going to, again, if I have to make these predictions in order to manage money successfully. The prediction is he cares more about inflation than he does slowing growth. And remember this, Powell is going to get, let me back up. Powell has said in no uncertain terms that he is what? Data dependent. Well, he's going to get data in arrears of lagging economic data. So he's going to get, slowing GDP data in June for what happened in May, but he's got to react to the inflation that's already expressed in the CPI. So he is going to, in my opinion, destroy the stock market, freeze the credit markets, and then he'll stop. Here's a better question: what does he do when the credit markets freeze? What does he do? Well, the only thing he can do is say, I'm not going to drain the balance sheet any longer. Okay. Is that enough to solve the problem? Does that fix everything right away? I mean, in normal times, Dunnigan, what the Fed does is they have a recession. They finally get hit with the data in arrears that the recession has already began, which was predicted by the stock market and credit markets. They then cut interest rates about 500 to 600 basis points. And lately, the latest thing is they print trillions of dollars to monetize the Treasury, spending money to give to people in bread and circuses, handouts. Well, which one of those things can they do in the middle of 2022? Well, they can't lower interest rates because, as you pointed out, they'll be very close to zero. So it'll be a very marginal decrease. Can they really print trillions of dollars to monetize a government that's spending money to hand people, helicopter money? I just don't see that will in Congress to do it at this point. So the answer is there's really not much the Fed can do. The Fed put is much lower than people think it is. And even when that put is triggered, there's really not much they can do.
So this leads into how does that play out in terms of observable consequences that ordinary people in the cheap seats will see? Fazdal asks, Mike, your prediction of a melt-up followed by a recession is still looking good, but between Putin and the Fed, the timeline keeps getting pushed. So instead of looking for dates, which key events should we look out for that would signal either a melt-up or a recession?
So I never said melt-up. I was one of those people who said that we were not going to melt up. Melt up in what? I mean, I was, I had short positions on in January in the portfolio, very defensive, consumer staples, think of, Walmart, bond proxies, bond-like proxies like utilities. So I never thought there was a melt up. I was somebody, I have a lot of clients who tell me, somebody's out there on the internet claiming there's going to be a melt up in the stock market. No, we already had a melt up. The stock market was 200 at its apex, 210% of underlying GDP. That's a melt up. We already had the melt up. So the next thing is a meltdown. So what I'm looking for now is disinflation, which was postponed because of the war. Disinflation will start in the middle of this year. It'll morph into outright deflation as we see the junk bond market meltdown, the stock market meltdown, the real estate market meltdown. And then on the other end of that, I think we have some protracted period of stagflation, possibly much more intense than we've ever seen before in this country.
And those of us who lived through the 70s know that that was intense at the time. It had drastic effects on people's lives for a significant period of time. There's a question here that's kind of interesting because it turns this whole thing upside down for you. Peter Mangano says, what would cause you to question your base case?
What would cause me to question? I always question. Any good money manager always questions himself. I just flip on CNBC and you'll see me question myself all the time. Every time Tom Lee comes on, I'm like, what am I missing something? What world am I living in? The consumer, he says, like, the consumer's in great shape. Well, the consumer, before almost every recession that I can think of in my lifetime, the consumer's in pretty good shape. A great balance sheet, their home prices are through the roof. In 2000, their portfolios were through the roof. And then, the denominator crashes, but the numerator, the debt remains. And all of a sudden you say, oh my gosh, we were in such great shape. Well, there's a record amount of corporate debt outstanding. There's a record amount of sovereign debt outstanding. If you look at the total debt of the United States, we're close to 400% total debt, public and private, as a percentage of GDP. So we're about as over leveraged as we have ever been. We are as over leveraged as we ever been. And, not in nominal terms, it's through the roof. It's only, at the all-time high because the denominator is very high. But denominators tend to shrink very violently in recessions, and this one will be no different. So, we're in a lot of trouble, and I question myself all the time, and that's why I have a model. I don't get up every morning and read headlines. I look at data. And I mentioned a few of my components in the model, and I said, wait a second, why is the yield curve compressing? Why are LIBOR spreads rising? Why are credit markets under stress, both here and abroad? I mean, why are European banks in deep trouble? What's the fallout from the Russian, they're going to default. I have a very strong opinion on this. I think Russia is going to absolutely default on their dollar-denominated debt that they owe. They can't pay it in rubles. They pay it in rubles. They've defaulted on the covenants of their debt. So, and European banks have a lot of exposure to Russian bonds. And then if Europe goes into recession, are we going to be on an island here? What are our exposure? What is the U.S. exposure to European banks? So, Wall Street thinks we're going to have 10% earnings growth this year. That estimate has to come way down. And that's why you're seeing the stock market on very shaky ground.
There's a question here from John Berman who says, what does Mike think of the apparent acceptance of going to government digital currencies? He's concerned about metaverse. He's concerned about other things that aren't real. What about your view? And you've talked to us about this in the past, about government digital currencies. What is your view of the apparent acceptance of going in that direction by the government and by people who listen to them?
Listen, in 2017, I wrote about this extensively. Just to remind your audience, central bank digital currencies, I believe, are coming, unfortunately. But don't conflate that to mean that Bitcoin is going to be a success. I mean, listen, the blockchain is going to be used by governments. But if a government has a currency on a blockchain, they'll outlaw Bitcoin. I think the whole thing of the whole acceptance of these cryptocurrencies is just to get the public used to using a digital currency. And then when the Fed comes and says, hey, this is the CBDC that we're going to have. It's called the Fed coin. And you don't even have to have the Treasury then offering handouts to people. It doesn't have to go through Congress. The central bank of the United States hands you a wallet. Your central bank digital coin, a Fed coin, will sit on that wallet, and they will give you the money that you need. They can control monetary policy and fiscal policy, circumventing the Treasury. And they can control, not only they can see everything you do, everything that you buy and sell, reminds you of something, right, Dunnigan? Every transaction will be monitored, and they have complete control of interest rates. They can set that negative rate as low as they want, and there's nothing you can do about it. You cannot hoard money. You cannot take cash out of the bank. Only thing you can do is buy gold.
Yeah, when you said every transaction you make will be monitored, it can get worse than that. And we've just seen that rear its ugly head in Canada in the last month. And that's everything that you wanted to do can be shut off. You may be denied access to transact.
That's what complete control means. Unfortunately, that's where we're headed. Money. Listen, this is the consequence of going off the gold standard in 71. I mean, this was destined to happen. So you had a tool, a technology, which meant the government could create money and have no meaning. I mean, barter is the real form of money. I produce something and I exchange it for a good or a service. And then you dug gold out of the ground, which cost labor, capital. It had intrinsic value because it had an energy component to it. And that was a substitute for money. And then paper money was backed by gold. But it all meant something. It was real. It was a direct reflection on the productive capacity of the economy. Now it's meaningless. Now it's, hey, let's do $1.9 trillion in government handouts. A couple of keystrokes, there you go, boom, done. From the Federal Reserve to the Treasury. And the Treasury hands out that money with checks. Remember Mnuchin? Checks, big checks coming, big checks. Well, Biden did the same thing. Handed out checks. Janet Yellen. So much for the Chinese wall between the Fed and the Treasury. Janet Yellen. There's some more checks. Biden did it right, the first month he was in office. And you wonder why, if you hand people trillions of dollars, if you hand people $6 trillion and say, hey, just wait by the mailbox for your check to come. And you wonder why, they didn't go to work. Well, they stay home, and there's, the fallow level, the number of fallow people in the United States at a record high don't want to work, being paid to stay home. Hey, and you have bottlenecks and inflation. What a surprise, Doug.
How that plays out, you mentioned where else do you go to own something real in an era where everything is unreal, like creating $1.9 trillion of currency out of nothing in a blink of an eye.
6 trillion. 6 trillion.
6 trillion.
Altogether, 6 trillion.
Yeah, your scenario there was an incremental addition of 1.9 trillion. In that kind of an environment, you have varied, as you look at your forward-looking indicators, the percentage of someone's overall investment portfolio that's not being actively managed as a baseline in precious metals. Can you talk to us about where you're at in that arena, as far as looking at people's component of precious metals, what role that's playing in your model portfolio for people?
Well, I increased the amount of gold and miners in the portfolio to 18%. So I was 0 for a long time. Then I went to 5, and now I'm 18. So I'm almost at my max exposure to precious metals. And the reason why I did that is because I'm of the belief that there's maximum enthusiasm about how high the Fed can raise interest rates. I think we're at 7 interest rate hikes priced in on the short end of the yield curve. 7? If you have a yield curve, which is the biggest prediction of a recession that you can have. So whenever the yield curve inverts, the 10s minus 2s inverts, 10 out of 10 times you had it in a recession. So that difference now is 25 basis points. That's one rate hike, basically one rate hike. And the Fed is going to try to do it 7 times in conjunction with quantitative tightening at the same time, which is conjunction. I mean, how do you not? You'll invert the yield curve, you'll send the stock market tumbling, and we'll have the worst recession we've ever had in my lifetime, your lifetime. That's how it works. I mean, that's what's going to happen. And the Fed kind of has to pursue. They have no choice but to pursue that path, even though they know that's where it's heading, because they can't say, "Oh, it's 8% year-over-year inflation, maybe going higher." As we report March inflation in April, maybe higher, and the Fed does nothing. That in itself is going to destroy the economy. It already is. 40% of Americans have no savings, maybe like $1,000 or less, and don't own any stocks, and they rent. What do you think their discretionary purchases are? What do you think their ability to consume discretionary goods is right now? It's almost zero. Well, they're paying for food, clothing, shelter, energy. That's it. That's all they have. So the economy is already rapidly deteriorating. So if the Fed does nothing, the economy sinks. If they fight the inflation, the economy sinks. There's just no way out of it. And it's of course it was going to end up this way, because you can't live in the twilight zone forever. This is the revenge of the real economy.
Michael, for people who want to take advantage of your services as an active money manager, how can they get connected with you?
So you can call the office at 732-772-9500. I have a website, pentoport.com. There is a podcast called the Midweek Reality Check. It's $50 a year. You get some of my real data and honest opinion, non-agenda opinion of what's going on. And if you want to become a client, if you have around $100,000 to invest, you're a U.S. citizen, we have an info page on the website. You could always reach out to us. But clearly, the time of doing nothing, the time of just putting your money in a balanced portfolio of stocks and bonds, it's getting you destroyed. It's going to destroy your retirement, because there's a good chance both of those pieces melt down. In fact, it's already happening. Stagflation destroys both of those pieces, and that's where I think we're headed in the long. I think after this next recessionary meltdown engendered by a credit market freeze, the Fed is going to just say, okay, unemployment is going to surge, and you won't be able to sell a junk bond. You won't be able to issue commercial paper. Then the Fed has no choice. They have to reliquify markets. And once they do that, the holders of our bonds are going to understand there's no way the government can ever fight inflation without destroying the economy. So what does that do to interest rates? That's the key. So if you have a very high rate of inflation, what does that do to everything that the Fed isn't buying anymore? What does it do to mortgages? The Fed says they're going to sell several $1 trillion in, they have $2.7 trillion in of mortgage-backed securities, both residential and commercial. $2.7 trillion. And the Fed said they want them all out of their balance sheet. So, they're going to let that run off quickly, destroy all that money, also at the same time destroying money when they redeem their treasuries. So buckle up. It's not going to get I always like to say when you pick your bottom, I watch CNBC and everybody's a bottom picker. Oh, I think the bottom's in. I think the bottom. You know what happens when you pick your bottom a lot? You get really smelly fingers. So that's where I think I think we have a real big problem. We're seeing it now, and it's only going to get worse throughout the second quarter. And the second quarter hasn't even begun.
Michael, as always, thanks for joining us on Liberty and Finance. On behalf of all of our viewers, we're just grateful for your presence here. You give us a forward-looking view that's indispensable. It helps people to be aware and prepared. That's what we're about here. So, as always, thanks for joining us on Liberty and Finance.
Thank you, Donegan. See you soon.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.